Hello Gr10s, welcome to today's lesson. We are continuing with the final accounts and adjustments to the sole trader. Now remember, last week we covered all the core principles. We looked at them. I'll quickly name them again. Remember, it's your historical cost, it's your prudence, it's your materiality concept. We looked at the business entity, the going concern, and then the very important one when you look at financial statements and completing these financial statements at the end of the year is your matching principle. Remember, we need to match all your income and all the expenses that take place in a particular financial year. Remember, any consecutive 12 months, that's a financial year. We need to record those income and expenses in that year. Say we received too much for the year and we already received in advance, we need to take it out. Or if we did not pay an account yet, but we already used the service, let's say we use some data or internet through a telecom provider, then we need to still record that expense in this current financial year because we used it in that current financial year. So before we go on with more adjustments, let's go and look at the year-end procedure again. So number one, if you can remember, we looked at it last week, the pre-adjustment trial balance will be given, and this is before adjustment. So read very carefully. You'll also get your month, the end of the year month on that line. They will normally give you a heading saying, this is the pre-adjustment trial balance of whatever business for the end of the year 30 June 2015. Then you know that is my end of the year. And this trial balance has been given before any adjustments have been completed or put through. Now, what do I do next? Number two, I go and do all these adjustments. Now, where will I show these adjustments? For now, we're going to show them in the ledger accounts, or if there's a longer process, remember, I'm going to use the GJ, the general journal, then we'll post the general journal to the general ledger, and then the general ledger needs to close off, all the nominals in that general ledger needs to close off, and then we'll start with the final accounts. And we are really going to look at the final accounts at the end of today. Number three then will give you the post-adjustment trial balance. Now, that is just before you close off all the accounts. Now, the post-adjustment trial balance will have the full balance sheet section and the nominal section, but you need to remember, a post-adjustment trial balance is given after all your adjustments are put through, and that will be your closing off amounts, your year-end figures. Then, like I already mentioned, you'll have your closing transfers in your general journal, and you'll post it to your general ledger, and that's where the nominals close off. So your nominals will close off and your new final accounts will also close off. You'll have two new final accounts. You'll have your trading account, and you'll have your profit and loss account, and these two accounts will close off as well at the end of the year. And then the very last thing we look at is your post-closing trial balance, and that means all the nominals are closed off and we only have the assets and liabilities and the capital. Remember, the capital, the money the owner contributed and his profits, that will be left at the end of the year. Now, let's quickly just touch on the final accounts again. Your first one, your trading account, that is the account where we will calculate your gross profit. And what does that mean? That is where we take the cost of sales and we take it from your sales to see. This is my trading business and I traded during the year. What did I make through just buying and selling? But now remember, that's not where the business costs and incomes end. They will have other income and other expenses, and we'll show those in the profit and loss account. And then at the end, the profit and loss will give you your net profit. And then that will be taken to the capital account of the owner because the business was started by the owner to generate a profit. Let's go and look at our very first adjustment. This adjustment is connected to your trading stock and now a new one, your consumable stores. What is consumable stores again? That will be all items used within the business. So anything can be consumable stores if I use it. I consume it, like stationery, your packing material, it can be cleaning materials, it can be your groceries, like your coffees and teas, your refreshments that you give to your employers. That can all be regarded as consumable stores. Now, let's go and read the first adjustment. I'm giving you the extract from the pre-adjustment. So again, before any adjustments have been done, trial balance on 30 April 2016. I'm giving you trading stock, and as you can see, the trading stock given is 400,000, and stationery which is an expense, and this expense is given as 4,500. Now, what do I need to go and do? Read the very first adjustment. The owner took 2,500 rand, so he took it, worth of goods for own use on the last day of the current year. Now, this is not recorded yet, guys. So I'm going to quickly give you 1 minute. Identify the two accounts, identify the account debited and the one credited, and let's see if you can do it. I'm giving you 1 minute. Okay guys, so let's go and look at it. Hopefully your drawings went up, you had more drawings on the debit side, and your trading stock went down on the credit. So let's go and enter it in your ledger. So your drawings went up at the end of the year. What did your owner take? He took trading stock, and we will record it in your general journal, and he took 2,500 rand worth of trading stock. Now, I'm giving you the trading stock account. Remember, it's a plus minus account. And what happened here? He had a drawing of 2,500. And as you can see, my debit equals my credit. So therefore, you have the two entries, one on either side. Now, let's go look at the next one. And I do see that your balance here given it as 400,000. Let's go and fix it quickly. Is wrongly entered here. So what you can do in the exam, just go and rectify it here because the answer book is wrong. You can just fix it because you have the answer given on your question paper. So very neatly, just draw a nice line and correct it. Now, let's go and look at your next adjustment. The physical stock count showed an amount of 240,000. And they say further, stock and 500 rand worth of stationery is on hand. Now, let's go and check. I have trading stock on hand and I have stationery on hand. Now, I have two things on hand. Remember, your trading stock is an asset. And this asset needs to now decrease because I only counted 240,000 rands worth of stock. So there's some stock missing. But remember, your owner also took goods. So that's your first part. Your second part, there's also stationery on hand. Now, if we have stationery on hand, we didn't use it for this year, but we have it in our possession, right? So this stationery will only be used next year. So now I want to know, when will the expense actually occur for the stationery? Will we have the expense this year, or we actually only use the stationery next year? And you are right, we'll only use the pens next year. So these 500 rands worth of stationery, these items will only be used next year, so that making it an expense for next year. But let's go and look at your trading stock deficit. Remember, we only counted 240,000. Now, let's go and see. Let's look at your trading stock. Remember, you did fix it here. Now, very nice. Do a calculation for me underneath. So we have 400,000 in your books, but your owner took 2.5. Do you see? And then, what else? You also lost, or you counted 240,000. Now, how much then is missing? And this is your missing stock. Now, guys, remember, we need to be prudent. There's stock gone. Stock has gone missing. what stock did we lose? And very nicely, let's go and calculate it quickly. So we'll go onto the calculator and we'll say 400,000 minus 2,500 minus 240,000. And that will give you 157,500. And this stock is missing, guys. So as you can see, we lost a very big amount of stock. So they're not controlling their stock very well because so many items have gone missing. Or what else could have happened is we have so many stale items, so stuff rot in our shop, and then we need to dispose of it, but we don't record those items. But this still means we lost stock. So what do we go and do? We go to your trading stock and we say we need to decrease our trading stock because we are being prudent. We don't have all the stock left. And we are creating a new tier account called trading stock deficit. And how much did we lose? We lost 157,500, and that now needs to go to a new account called your trading stock deficit. And this will be an expense in your nominal section, and therefore you'll have to put in the date, and you will say, what did I lose? I lost trading stock, your contra account, your GJ, 157,500. Now your asset is now being done. What about your expense? Remember, we have stationery, also an expense. In our pre-adjustment trial balance, we had April the 30th. That is the amount we have in our books. But did we use all 4,500 worth of stationery this year? And your answer is no. So we have 500 Rand left at the end of the year. So what should we do with this 500? This is an asset because we can sell the stationery. We can dispose of it and get money for it if it's unused. And these items we counted, it was in the storeroom, it was unused at the end of the year. So we can go at the end of the year and say April the 30th. We can say consumable stores. I'm going to write it out on hand. And that means we have the stationery on hand. This consumable stores means we can consume it, but this now creates a new asset. And we need to say plus minus, and this asset will go up. And we will go and say stationery. I'm going to abbreviate. Please don't abbreviate in your exams. 500 Rand. And there you can see we have that asset at the end of the year. So at the beginning of the next year, we'll take it back to stationery and say we're starting with this 500 Rand worth of stationery and we're calling that a closing transfer again, what we just did. And then we transfer that amount again in the beginning of the year. So we're transferring the amount to show that it's an expense at the beginning of the next year. But while we are talking about final accounts, let's quickly look at your trading stock deficit. Your trading stock deficit and expense, it needs to close off to your profit and loss account, and you will see that we already made a big loss of 157,500, and then your stationery, a nice one. Remember your bigger side 4.5, take it over to the other side 4.5, and now what stationery did I use? I used 4,000 Rand, and that will go to your final account called your profit and loss, and we'll look at that one again at the end of today. Now, let's look at the next adjustment quickly. I'm giving you an extract from the pre-adjustment trial balance on the 28th of February 2015. That's my end of the year. But let's go further and read the adjustment. So adjustment 2 for today. Remember, no company is now correlated. We are doing examples one by one. The premises have been hired since 1 March 2014 at 3,000 Rand per month. So that is the monthly payment. But now, what happened? As from the 1st of January 2015, do you see it's a couple of months later, 10 months later, it went up. The rent increased to 3.5. But now, I'm giving you a total expense of 40,500. Now, guys, what should I do? I'm not really telling you what to do. So if I don't really tell you what to do, go and calculate the perfect world amount. What was the perfect amount received for this year or then paid for this year? Now, we're starting this year on the 1st of March. So let's draw the timeline. I'm going to say the 1st of March, it was 14. As you can see, the end of the year, 28 February, 12 months, 15. But now what happened? We had an increase on the 1st of January. Now what happened? It went up with 500 Rand. Now, there's a few ways you can do this. Now, let's go and check. For the months of March to January, you'll see, if you go and count them, the 1st of January, remember, we have 10 months, and then here we have 2 months. So for 10 months, up to the 1st of January, they paid 3,000, and here we are paying 3,500. So if we say 3,000 times 10, it will equal to 30,000. But now, for 2 months, we should have paid 3,500, and that will give you 7,000. Now, how much in total should I have paid? Yes, 37,000. But how much did I pay? And as you can see, we paid too much. How much too much did we pay? Let's go and do the calculation. Let's say minus 4,500, and then you can see that we've paid 3,500 Rand too much. So this is the expense for next year. So we need to transfer this amount out of this year's expenses account and keep it for the next year. Let's quickly go and look at your T accounts. Here they are. Remember, expenses plus minus, so we need to decrease your expense with 3.5, and then you will see we have to take it to a prepaid expense account. We'll use the GJ. Prepaid expenses and assets. So they owe us this money, and why do they owe us? Because we prepaid our rent expense with 3,500, and this will be a transfer at the beginning of next year. But how much was my full expense? This is the bigger side, 4,500. On the same line to the other side, 4,500. That's step number 2, and then you'll balance this account out. You will see it is then 37,000. And that then will be your profit and loss. Just want to quickly double check your calculation here. To just recap, 30,000 and 7,000. That is your full expense for this year. The 3.5 paid over is actually the expense for next year, and we need to match that to the next year. So therefore we transferred and call it a prepaid expense. Guys, I'll see you after the break. Okay guys, let's look at another adjustment. We've done this one last week, so this is a bit of revision. Water and electricity is owed for February 2016, and the amount is 1,200 Rand. Now, I want to know, what will happen to your water and electricity account, and where should I post this amount to have the double entry rule? So I'll give you 2 minutes to quickly complete this adjustment. Okay guys, I know you got this right. So let's look at the expense. It's water and electricity. It's an expense for this year. Why can we say it's an expense for this year? Because we received an invoice. This invoice was received but never paid. So does that make an expense for this year? Yes, it's an expense. So your water, electricity, and expense goes up for the year. And remember that it's a negative for your owner's equity, because your expenses went up. Your owner is unhappy because you have too many expenses. So you'll record it in here and call it a crude expense. It means it's not paid yet, 1,200. And let's go to the crude expense minus plus, and it's a liability. And let's go and fill it in here and call that water and electricity. It's the end of the year, GJ, and the 1,200. Now, if you want to be 100% correct, it's February, so therefore February the 28th. And please, guys, be as thorough as you can be. If you forget these dates, it's not a major train smash, but they can subtract marks, or it doesn't look complete. So please include all the dates. Let's go to another adjustment. The extract from the pre-adjustment trial balance on the 30th of June. Now guys, I want to give you 1 minute to quickly tell me, what is the beginning of this financial year? Let's go and draw a nice timeline. Put the beginning of the year and the end of the year on this timeline and go and count the months. Make sure you have 12 months. I'll give you a minute to answer this. Okay guys, let's go and look at your timeline. So there's a nice timeline. Let's draw it. The end of the year given 30th of June 2011. Now, what is the next day, guys? The next day will be given as the 1st of July, because that's the following day after 30th of June. But what's the previous year? 2010. And as you can see in our adjustment, we already have this date here. So if you got it, great. If you're still struggling with it, remember, you need to count 12 months. So if you count backwards or forwards, doesn't matter. Just count and know that you need 12 months for your financial year. But now let's look at the adjustment. They say part of the building has been let to Gr10 since the 1st of July 2010 at 2,000 Rand per month. Now, again, I'm not telling you how much your full income will be, because you are letting this piece of building to Gr10 and she needs to pay 2,000 Rand, or you need to pay 2,000 Rand. But for how many months should we have received? Only 12. Now, if you go and look at the figure here, you'll see the figure is 26. Now, let's see. In a perfect world, we will have 12 months times 2,000, and that will give you an income for the year of only 24. But now, how much is it stated in your pre-adjustment trial balance? It's stated above. So did we receive too much or too little for this current year? And your answer should be we received too much. How much too much? So let's go and subtract 26, and then you will see the difference is there for 2,000 Rand. So Gr10 paid us 2,000 Rand in advance for renting this piece of building from us. So what should we do? Is this 2,000 Rand an income for this year? Or does this make it an income only for next year, and your answer is correct. This is an income for next year only. So, guys, I'm going to ask you, quickly complete the entry in the ledger. Now, if you don't have ledgers, quickly draw small t accounts, small t's, make the heading rent income, show me what happens to rent income. Does it go up or down? Where does it go up and down? And then draw the other T account. I'm not going to give you a clue. Go and draw it and show me. Is that T account debited or credited? 1 minute. Okay guys, let's go and look at those T accounts. You'll have the rent income, and remember rent income and income minus plus, and remember also the more income you get, the happier the owner gets. The less income you get, the unhappy gets. Therefore owner's equity a minus plus account, and therefore it's correlated. Now what happens to your rent income? We need to take it out because we received too much, as you can see. So we will go and write there the June the 30th. We will take it where? To income received in advance. And please write everything out in full. Gr10. You can't abbreviate like I am. Now if you go and add up the biggest side is the credit. It's 26. You need to take it over on the same line to the other side. That will give you 26 minus the 2. And this will then give you the perfect year amount of 24, and to close it off, we'll close it off to profit and loss, and that will be then also a GJ entry. But remember, this is your debit. Where's your credit? Your credit will be given in your income received in advance. It will be a liability, therefore a minus plus account, and you can write it in on June the 30th. We'll write the rent income, and it will be a GJ entry, and it will be 2,000 Rand. So guys, this 2,000 Rand was received before the due date, before the due year even. So therefore, it makes it an income for the next year. And as soon as we start the next year, we'll transfer it to the rent income account, and then we already received some income for the new year, which will be 2,000 Rand. Let's continue to the next one. I'm giving you an extract from the pre-adjustment trial balance on the 28th of February 2012. Now again, what's the beginning of the year? The next day is the 1st of March. But what is the previous year? 2011. And that will give you your 12 months. But I'm telling you now, we have a fixed deposit at Tabang Investors, and we have 150,000 Rand here. Now remember, there's two ways to calculate the interest. We can have interest, and we can have it as not capitalized. That means it doesn't go into our investment account, and they will give you your interest every month or every 2 months, or we can have it capitalized. So therefore, they will pay your interest into your deposit, into your investment account. And this fixed deposit is an asset, and that asset makes it a positive on the debit side. We have an investment, we have a fixed deposit, and we can tell them whenever we need that investment back that we need the money back. Now, let's go and look at the statement Tabang Investors gave us on the 28th of February. As you can see, they also have the opening balance of 150. But now, they told us we earned a question mark on interest, and now we have an amount at the end of the year in our account of 180. Now, as you can see, our investment grew. It went up from 150 to 180. So therefore, how much did we get? How much did we gain this year? And if you go and calculate it, you will see we had an increase of 30,000. And what did they do with this 30,000? They've included it into our investment account. So now I want to ask you, is it then capitalized or not capitalized? And if you answered capitalized, you are correct, because we put the interest in the investment account. Like here, they've included the interest in our account. They didn't give us the money. So therefore, we need to go and do the entry and record it, because this interest is now an income for this year. We received this income in our fixed deposit account or our investment account. We didn't receive it physical hard cash, or they didn't pay it into our bank account monthly, but we did gain throughout the year. So how do I show it in my accounts? So therefore, your fixed deposit, let me quickly just draw a line here, should be then March the 1st, because it's an asset. So that entry is wrong. We are fixing the entry. March the 1st, we'll have a balance on the debit side because it's an asset brought down of 150. Now, what did we do? We had to increase it February the 28th. Why did we increase it? Because we had interest on fixed deposit, and it's your GJ entry. How much did we get? 30. And as you can see, if we add the side up, you'll get 180. It's your bigger side. Let's take it to the other side. We'll write there 180. And then, what is your balance carry down? Let's put it in here, 180, and let's say February the 28th, balance, and it's carried down, and let's see, did we create this credit here now? We need to place it here. This is a debit now, and we'll say March the 1st, balance brought down. Now, didn't we create this entry here as a debit entry? Where will my credit entry be? Let's go and see. Interest on fixed deposit, it will be a minus plus T account. It's an income for the business. Where did we put the interest? We've put it into, what is my T account name? So be prepared to use the fixed deposit, Tabang Investments. So fixed deposit, Tabang Investments, that's your T account, the end of the year, February 28, and that will be then 30,000, and this is an income. But remember, all your income needs to close off at the end of the year. We'll close it off, end as well, profit and loss, GJ, and we'll take it to then the credit side of your profit and loss account that we will cover now in your last segment today. See you after the break. Okay guys, so we're starting now with a very difficult concept, so please pay attention and listen carefully. Depreciation will be introduced this year. We're introducing it now, but it will be continuing to get more difficult in the future. So in grade 11 and 12, we're still going to have this. So the better you know the foundation and understand depreciation, the better for you and your future in accounting. So let's look at it quickly. What is depreciation? Again, remember, when we buy vehicles or equipment, it loses value over time. And this is a way to record the value lost. Remember, we can't touch the historical cost price. We will always record your vehicles and your equipment at that price. But remember, it's not that, it doesn't have that value, it doesn't carry that value during, say, the third year of use. So therefore, it does lose value. Now, depreciation, very easy, is an asset. It's when an asset decreases its value over time. And then, very important, we can use two methods. I'm going to go through these methods in great detail in a minute. Number two, it's the decline in the market value of an asset. It's normally because of wear and tear, it's the obsolescence, it's getting too old to use, or we're using it. We're using it too much, and therefore it loses value. The last couple of notes, this decrease is called depreciation, and that will be an expense for a current year. So if you use the asset for that year, it's an expense. And then depreciation is calculated normally at the end of the year, especially in grade 10, always at the end of the year. Depreciation is dealt with as an expense, and it's only on equipment and vehicles. So that's a few notes that you need to know. So let's continue with the info. I want to give you 1 minute and let's see if you can explain the following words for me. The first one is depreciation. Next one, accumulated depreciation. Third one, carrying value or your book value. And then lastly, depreciable amount. I'm giving you 1 minute. Okay guys, let's look at your answers. So depreciation, very easy. Let's quickly open that. It's an asset that decreases in value over time. The decline in the market value of assets generally from wear and tear or obsolescence is called depreciation. Depreciation is an imputed expense because we allocate part of that cost to a specific accounting period. Now again, imputed expense, it's not a physical cash expense. Accumulated depreciation is the total depreciation over time on the asset. The carrying value is the original cost price less the depreciation that has accumulated over the period in which the asset has been in the business. And the depreciable amount is the total cost less the residual value. Now, if you know these terms, it will make it a little bit easier. But now let's continue with the two different methods on how to calculate depreciation. So, methods to depreciate assets. Let's look at the left-hand side of the screen. The cost price method is one way of explaining it. Or we can say it is the fixed cost method, or the fixed installment method, or the straight line method. So we can use interchangeable words or descriptions for calculating depreciation on this method. Now, this is the easiest method to use. Why? It takes place over the useful life of an asset, so normally 3 years, 5 years, 10 years. And then, let's go and look at the very important thing. Depreciation is calculated on the cost price every year. So for example, if I have an item, so let's say a vehicle worth 100,000 cost price, what will be the depreciation every year? 20%, and therefore I will lose 20,000 Rand every single year until I finished and got to 100,000. Now remember, I can't just say 100 minus 100 and then have 0 after 5 years. I need to have a residual amount of 1 Rand in the accounting records to at least prove I still have an asset. So in total, you can lose 99,999. So therefore, you'll have 1 Rand left on the 5th year because you'll have 20%, 40%, 60%, 80%, and then the last 100%. But 1 Rand needs to be kept in the books to show that you have an asset. Now, the other method, the more difficult one that we'll deal with, and we're going to do a few exercises on it today. We have the diminishing balance method. Another name for it is the reducing balance method. So again, we have 1, 2. Carrying value method, that's 3. The book value method, it's 4. The declining method, that's 5. So we have 5 different names to describe this method. Now, writing of depreciation on the carrying value is very important, or the book value. Now, how do I get the book value? I take the original cost price less the depreciation that has been accumulated over the period in which the asset has been in the business. So let's say I had this business for this item in the business for 3 years. I already lost value for year 1 and year 2 and year 3. So therefore, I'll have to add that up and take the cost price minus all the value lost, so those 3 years, then you'll get the book value, and that's the amount you need to calculate the percentage out on. So let's go and look at it. It will be your cost price minus accumulated depreciation. And an example, let's take, for example, you use 20% still, but you're using say the book value method. You take your cost price minus what you've lost the previous year, and then you will get on the second year 16,000 Rand as depreciation. So as you can see, the more you calculate and the more you have, the longer you have the vehicle or the equipment in your business, the depreciation will get less and less and less every year as we go on in time. Now, let's go and look at a quick question. What type of accounts are the following? And I'm going to give you 1 minute to answer this. The prepaid expense, accrued income, income received in advance, the accrued expense, and then the depreciation. And I'm asking this, I want your answers in a minute. Okay guys, I know you got all of them right. Remember, your prepaid expense will be an asset. Accrued income will also be an asset. They owe you money. Where income received in advance, you owe someone. Accrued expense, you owe someone. And then depreciation will be the expense. Now, I'm going to give you information. Let's go and look at a depreciation example. The financial year end of Kia traders is 31 December each year. Now, you bought a vehicle for 100,000 Rand on the 1st of January 2013. So as you can see, your financial year runs from January to 31 December. And let's look at this 12 months. These 12 months will be then until 2013. That's 12 months. But now, you're required to calculate depreciation at 20% on what method? The cost price method for 3 years. 31 December, that will be year 1, 31 December 2014, year 2, and then 31 December 2015, year 3. Now I'm going to show you the very first 2 years. Let's go and look at it. Your year 1, you will take your cost price, and as you can see, your cost price does not change. It stays the same. The cost price will never change. That's the price you've paid for this vehicle. Now, the first year, you've used it for 12 months. So again, on your calculators, you'll have to say 100,000 times 20%, and that will give you depreciation of 20. Now, what did you lose previous years? You didn't have it the previous year, so you have to say 0 plus 20, and that will give you your accumulated depreciation then of 20 for this year. So the very first year, your depreciation and your accumulated depreciation, all the value lost, accumulated depreciation will be the same. So what is your book value? You take your 100 minus your 20 to equal your 80,000. Now, what do I do the second year? The same calculation, 100,000 times 20%. You see that's your second year. Therefore, you lost again 20,000. So your depreciation, your expense for this year will be 20. But now, how much did you lose in total? 20 plus 20, and that will give you your 40,000. Now, how much is your book value? You take your 100 minus your 40, that's the value lost, to give you your 60,000. Now guys, I'm going to give you 1 minute to calculate the last year, the 2015 period for me. Okay guys, I know you got this one right. So let's go and look at it. Remember your cost, 100,000. And then your year will be the 31 December 2015. That's your end of the year. But now, what did you do? You calculated the 100,000 times 20% for the full year. That will equal your 20,000, as you can see. Now, let's see if you got your depreciation correct. You see it's 20,000, but now, how much value did you lose in total? You take your 40 plus your 20 to give you 60. And now your carrying value. What's your carrying value? 100 minus 60 to give you your 40,000. Now guys, this is the easy way to calculate depreciation. I want you to go and practice this a bit. But let's go and look at the closing transfers because I want you to study these. Now, your closing transfers. Your nominal accounts always need to close off, and this will be your income and expenses. So you need to go and study this, then we'll calculate your depreciation on the other one next week. The profit for the year is then determined, and then the balances of these income and expenses accounts cannot be carried forward to the next financial year, and therefore they have to be closed off at the end of the current financial year. And the procedure for the closing transfers are as follow. Let's go and look at the steps. Now you have 7 steps. Please guys, study the steps with your depreciation, especially the one on the easy method, the cost price method. Okay, step number 1, you have to close off your debtors allowances to your sales account. So your debtors allowances will close off from the credit side, you'll take it to sales on the debit side. This will be your net sales. Step number 2, close off sales to your trading account. So sales will go to the debit side, trading account will now be credited. Then step number 3, close off cost of sales to trading account, and then trading account needs to be calculated. Your gross profit will be calculated there, and you will take it then to your new account called profit and loss. That will be step 4. Step number 5, close all income on the credit side to profit and loss. So therefore all your income will now be on the credit side of your profit and loss. The next one, you will have to close off all your expense accounts to the debit side of the profit and loss, and then you'll go and calculate the net profit for the year. And this net profit for the year will then be taken to capital, and your very, very, very last one, your drawings needs to now be taken to your capital account. So guys, please study these 8 steps. We're going to use them in our next lesson. See you again soon. Keep well and study hard. Bye-bye.